Yo, what's up you guys? Welcome back to another video, and in today's video I want to educate you guys on what is market structure, what is price action, how price action is created, and also teach you how to manage your risk and why it is important, which is going to be the biggest lesson that you will learn for 2022. Now, before we get there, if you're new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. And if you enjoy the video, please do consider hitting that thumbs up button as well. And let's try and get this video to 100 likes, my good friends, as well. But before we get started, a massive thank you for us hitting 4,100, actually 4,000 subs. It's been a big milestone, and it has always been a goal of me to get people educated, as much people educated in South Africa as possibly and all over the world as I can. And I'm grateful for each and every one of you that had hit that subscribe button. My friends, this is the biggest Christmas box that I've received. Thank you so much. I appreciate you guys as well. Now, let's jump into the data. Now, if you've ever done a course with FX Sheeps, Trevor Noah, or NAS 100, NAS 100 dog, it doesn't matter, it really doesn't matter. Even with the guy from Italy who just became a DJ, whose name starts with an M, who does smart money concepts, order flow, order blocks, and all of that stuff. It doesn't matter what your strategy is or what your system is. If there's one thing that stands in everybody's strategy, it's called price action. And price action gets developed through market structure. Market structure gives us the flow of the market. It's where you'll see the highs, the lows, the lower lows, and lower highs. And that is basically technical analysis in a nutshell. A lot of people will tell you, yes, but this is an order block. People would say this is mitigating an order block. My friend, mitigating, fatigating, order block, order flow, I don't care what you call it. It's support and resistance, and you can stand on a roof, take a parachute with no rope attached to it, and make and convince me about all of these fancy words, but there is only support and resistance in the market, which is price action, and that is created through market structure. How is market structure created? Now, if you sit there and go, yes, but Trevor Noah, that guy, he uses trend lines. Well, trend lines is also support and resistance. Trend line, counter trend line, whether you trade in a channel, whether you trade on a bus, whether you trade on a train, my friends, one thing that is certain, like Warren Buffett say, you buy low and you sell high. Buy low, buy support, sell high, you sell at resistance. Now, what is market structure? Market structure is the flow of the market. It tells us which way the market wants to go. How is market structure created? Market structure is created when you get a green candle printed next to a red candle. That is called market structure. And when market structure is created, what do you get? You get a successful trader that you'll never find in South Africa. I'm just joking. Then you get price action. Now, this is called level of resistance, and this is called a level of support. Okay, this is the low of the market, and that is the high of the market. Now, price action has been in development, well, not in development, has been used for many years. Whether you use fundamental data, technical analysis is used to get an entry into the market. Now, like I said before, when you trade price action only, there's only two places that you will buy. You will either buy there, or you will buy a break and a retest, and you will buy that continuation, right? Which is what most people paid FedStex 3,500 for, a lollipop strategy, which was basically a break and retest of a consolidation market. My friend, if I catch you, I will squash you for the lollipop cockroach you are. But this is the two places that you will buy nowhere else, my friends. the next place you will sell is you will either sell at that location there, or you will sell at this location. These are the two safest places to sell, and these are the two safest places to buy. Now, we sell at resistance and we buy at support. Now, when you get market structure, you get a green candle next to a red candle. You get resistance, you get support. When support gets broken, it becomes resistance. When the resistance gets broken, it becomes exactly support. And you can trade this market day in, day out, until thy kingdom come. Why? Let me show you why. Let's assume that you never paid anyone to do a course, right? Let's just assume that. Let's assume you've never watched the guys sell robots, because nowadays the only people who makes money in the industry is the people who's selling the content, right? If you look behind me, you can see I don't live in a mansion, I don't live in a fancy house. If you see the headphones or the t-shirt that I'm wearing is not fancy. I don't have a fancy car. Nothing about me is fancy, because my best interest lies with the public, not because I'm regulated by the FSA. If you didn't see that, just check the previous video where I've publicly shown it. But my best interest lies with helping the public. Now, if you've ever in your entire life paid someone for what I'm about to show you now, then I suggest you get a full refund. Let me show you. Trevor Noah teaches his people that you have to trade within a yeah, you don't know. Okay, so they basically trade within a what they call is like a tunnel. They call this tunnel trading. There's a guy who sells an indicator called the tunnel trading vision. Why would I need a tunnel trading vision robot that is going to teach me something I can do manually? That other guy also, what's his name? John Bugatti, that guy, also selling robots that only trades price action. They make you pay a lot of money for stuff that you could have just done all by yourself. Now, let's go back to Jason Noah. So, yeah, because I've seen this. Okay, so what they do is you get something called tunnel trading, right? So you get where you basically trade within the trend, because the trend is your friend, but the trend doesn't always hold. Now, even with trend line and counter trend line trading, now a trend line is when you draw a line that goes with the trend like this. A counter trend line is where the trend is going up, okay, and you drawing a trend that's going down. A counter trend line would look something like this. If you draw this trend line there, this would be a counter trend line. Why? Because the trend is going down, but you're drawing the trend line up. This would be the correct way of drawing the trend line to the downside. Now, why is this useless? Because even with the trend line there, the trend line still bounces off support and resistance. Why do I say so? If you remember the concept that I've just explained to you, you will notice that we are going to identify all of the structures that the market had created. Okay, so we're going to go through all of the structures there. Sorry about that. So I'm going to draw all of them for you. We're going to identify all of them. Here's one as well. Here's also one here. We're going to draw all of them. Excuse me for that. We're going to draw them, and we're going to draw there. Okay, what I've drawn for you over there is levels of support and resistance. See, this is also a level of resistance, but this also, if you go left over here, there, you can see all of this. That is what trading is about. That's it. Now, apart from that, what you also get is you get patterns like, you will get something like the head and shoulders pattern, which is also just an impulse correction, an impulse to the downside, but it's fine, right? Because they'll tell you, I'll teach you head and shoulders, I'll teach you inverted. Yeah, we've heard all of that stuff before. So then you get patterns in the market. You get head and shoulders, W's, M's, inverted head and shoulders. But at the end of the day, market structure will remain in the market. What do we have over here? We have a green candle next to a red candle over here. Okay, let me just remove this because there we go. So we have a green candle next to a red candle. We've got a green candle next to a red candle, 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 green candle next to a red candle. And you'll see how this market, right? The market basically moves just like this. Go breaks, retest, then breaks a little, but you wouldn't have obviously entered there, but you would have probably entered there. Then it breaks that structure, it comes back, retest it, and it go down. Now it's back there again. See, the market will just create and break structure, also known as support and resistance. Now, if you love trading the NASDAQ, you can go on the NASDAQ and you'd be able to identify all of these things that you paid the NAS guys or the NAS kids, whatever their names are. You pay these people to teach you something that is right in front of your eyes. You will see, my friends, if you have nothing to do this festive, go and educate yourselves. I don't know if this makes any sense, but you should know it makes a lot of sense for you. There. Sell, sell, sell. Equal high, sell, sell high, buy low. Here we have an equal low. You buy, and you can basically go through the entire chart and you can print market structure on it, and you can go through everything and you will see how these patterns keeps repeating themselves. That is what you need for technical analysis. Next up, we're going to talk about risk management. Why is risk management important? First of all, because why? If you don't know where your money is going, how do you know what is at stake for you? Now, I've made this example many times before. Let's assume you have $100 in your account, right? And you want to trade Euro USD, okay? But you want to risk $10 of the account. In fact, most of you don't even know what you're risking. So let's just say that you get a signal from someone that you have subscribed to, that you were waiting for, and the signal comes through and it says buy Euro USD. Now, let's assume you don't calculate your risk and you just go, okay, I've got 1,000 Rand. I can see the stop loss looks like it's gonna do me something good. So I'm gonna go 0.05 because it's 1,000 Rand. I'm just gonna risk one position. And now, what you don't know is that 0.05, well, in general, you should be risking 1% of your account. Why should you be risking 1% of your account? Because why? For every percent that you, well, first of all, you need to trade a 1 to 3 risk to reward. Okay, we call it a 1 to 3 risk to reward. Oh no. There we go. 1 to 3 risk to reward. And this means is that we are risking 1% of the account to make 3%. But I know most of you don't know how much you're risking, because I've seen a lot of people deposit 1,000 Rand and blow the entire 1,000 Rand with the NASDAQ, because you're not even allowed to trade NASDAQ with 1,000 Rand. You don't have the equity to trade it. Okay. Your money is too small. Let me just close this window. Like you see, like I'm so, like my window's right here. So what you need to do is always calculate your risk before the time. Let's assume we want to go and let's say we want to trade Euro USD. Okay. Now the thing is, there's two ways to do this. The first way is you come onto Euro USD and you say, okay, I want to sell the market at that price, right? I want to sell it. And I maybe want to take my profit at that level over there. Now, the thing is, you cannot just say you're going to use a 0.05. You need to make sure that you are risking at least 1 to 2% of your account. How do you do this? Very easy. Firstly, you come to TradingView if you want to. You don't have to do this. If you know how much stop loss your pips have, then you don't need to do this. You come into TradingView, you put your position, you put this on there. You double click on it, you go to inputs, you input your price, you input your profit, and you input your stop loss. Let's just say, assume that you want to sell the trade over there. You want to put your stop loss there because that's where we normally put our stop losses, because it's safe to do so. Well, not really. Now, all you need to do is keep your mouse over this thing. Then you'll see there that number 30, that is the amount of stop loss pips that you are risking. What you do then is you come over to the position size calculator and you say, good friends, I got $100. I want to risk 1% of my account. My amount of stop loss pips for this is going to be, what did we say, 30 pips, right? 30. We want to trade Euro USD. Calculate. Now, if you see there, you cannot even trade Euro USD with a standard lot. So you are supposed to go a mini lot or micro lot. Now, I know most of you are going to say, yeah, but I've traded this. It's fine. Like, I understand. It's the same reason why most of you are still trying to make money in the market because of $100. Now, let's change that around and say, trust me, nobody has ever become successful in trading with $100. Take hand for me. You can go fetch anybody out there who has been able to quit their job because of $100 they deposited. No, it's still a dream for me, and it's a dream for all of us to be able to flip $100 into 1 million or $500,000. It doesn't matter. Now, let's assume you had $1,000. Same thing. Now you go in the market and you say, I've got a 0.03. Now you're risking $10 to make, what is this? A 1 to 4.5%. So you're risking $10 to make $45. Now, a lot of people say, but $45 is not a lot on a $1,000 account. Well, guess what? There's a lot of people who doesn't even get paid that amount per day, even per week. So it is important that you understand. And this is the reason why a lot of people are not profitable in trading, because they're trading with small amounts, expecting to grow it exponentially over time. But it will take one trade, just one trade, to wipe you off the face of the earth. And if that doesn't satisfy you, then maybe you should do what your friends does. Okay? Because anybody can do this with a demo account, right? This. Okay? Guys, sell NASDAQ. I'm also going to sell NASDAQ. These guys don't feel anything because why? You're trading your real money because why? Why? Because you paid for it. So obviously going to risk your real money. So they come into the market and they trade like this. No risk management. They don't even tell you to risk 1%. You don't even know what risk management is. So you jump from this guy to that guy to this guy to that guy. Now, always make sure that you calculate your risk before you enter a trade. Always understand that no matter what your strategy is, you have to understand market structure and price action. Fundamental data is very easy to read if you use forexfactory.com. My good friends, I hope you've learned something here today, and I hope you have a very, very Merry Christmas, and I want to wish you nothing but the best just for you. Merry Christmas, and I will see you in my next video. Thank you for your time, and as always, cheers for ears.